Hello, everyone, and welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. I'm very excited today. We have a special guest with us. Bob Newman from Chatham Financial is with us, and I can't wait to bring him in. We're going to talk about a very hot topic today, derivatives, and we're going to get into what his company does. We're also going to talk a little bit about why your bank or financial institution would consider using derivatives, and we're going to get into some really interesting stuff. So with that, I'm going to bring Bob in here. Bob, thank you so much for joining us today.
Joe, thanks for having me. Great to be here.
Oh, great. Could we start off today? Could you maybe just tell us a little bit about the company and what the company does and what you do there?
Sure. No, glad to. So Chatham Financial is the largest and oldest independent advisor in the interest rate derivatives markets, headquartered right here in southeastern PA, Kennett Square, Pennsylvania. Founded in 1991. We really exist to demystify and equip and educate our clients, and in my case, community and regional banks, to make prudent use of interest rate derivatives to manage risk. My role is really helping institutions along the East Coast, so I cover the Mid-Atlantic territory for Chatham. But we started as a single. Our founder worked as a single practitioner out of his home for the first 5 years in the 90s. Started hiring some friends, rented some office space. I joined in 2003 when we were a 40-person boutique. And today we're an 800-person firm with offices around the globe, serving different client verticals, commercial real estate, private equity, corporate companies, as well as financial institutions.
And am I wrong, Bob, or did I just see that your company just opened an office in London?
We've actually just opened a New York office.
Oh,
So
I'm
the
sorry, New
newest,
York,
yeah,
New
no, it's
York, New
okay.
York. I'm sorry, yeah, New York.
Yeah, that with some new hires and just with concentration with financial expertise up there, for a bunch of reasons, we just opened up in New York. But we've our roots are humble here in the small town of Kennett Square. So it's a kind of a neat entrepreneurial story as to where it started out. But now, yeah, we are in London, we are in Singapore, Denver, Colorado, here in the U.S. as well.
Let me ask you a question. Would it be fair to say back in the mid 90s when this company was first started that derivatives were, I don't know, I don't want to say necessarily a new product, but a nuanced product, like something that banks really were not making a whole lot of use of back then, and that has built very nicely over time? Would that be kind of a fair thing to say?
I would agree, Joe. The first swap was done in 1981. I would say it was primarily a Wall Street with Wall Street marketplace in the very early going, mid to late 80s. In the early 90s, regional banks began to make use of swaps and hedging. But there were I would say there was a wild west as the market grew, and you had some speculative uses of I would say, an instrument that really designed to manage and reduce risk was sometimes used to take on risk. And you had some losses. Procter & Gamble, one of the most famous, and the outcry from shareholders who had these losses. They used to call derivatives off-balance sheet instruments because the accounting world did not know where to put them, so they put them in the footnotes. And therefore, when Procter & Gamble and some other companies took some outsized risks and lost money, the FASB completely changed the accounting standard to get derivatives onto the balance sheet. That was known as FAS 133, came on in the late 90s, early 2000s. And that, I would say, the complexity of that accounting standard just really gave a lot of pause to smaller banks. And that's where you kind of had this, I'll say, a little bit of a lockup in the market.
Okay, fair enough. Let's go into this for a second. Usually I wait to ask the interviewee their background a little later in the interview, but I think today I want to go into that up front because I think it will kind of play into as we go down the road here a little bit. So could you give us a little bit of your background and basically explain how you ended up getting into this line of business, and just how you have kind of evolved with the company here over about the last 20 years?
Sure. No, I could try. I'll try not to make this short story too long, But I started. I'm a commercial banker. I say it's in my blood. I was a credit trained commercial banker starting at Maryland National Bank in Baltimore. So I was a lender, did some work in the credit department. But the bank I was with, and we were just a regional bank in Baltimore, Maryland, decided to start up a swap desk in 1988. So I was kind of early into this market. But I go back to my college days when I left my home in Connecticut to go to school down at the College of William and Mary. 1979, well, Paul Volcker was just about to embark on his career at the Federal Reserve Bank, and we had a misery index with unemployment and inflation. So while I'm tucked away in a economics classroom at William and Mary, looking at the theoretical realm of interest rates and inflation, Volcker was sending the prime rate up to above 20%, and that monetary experiment, which successfully brought inflation down to much better levels. The unprecedented volatility in interest rates, I believe, really led to the innovation of this marketplace. Swaps came onto the scene to allow parties to transfer floating rate interest rates risk for a fixed rate guarantee. And the power of that exchange has made these products just continue to grow over the 40 years they've been in existence. So I feel like my college days and my early days in banking, we were coming through this, again, gyrating, volatile interest rate market that had never been seen before. Interestingly, a time that's being compared a lot to what we've been through in the last 18 months in terms of the velocity of the change in interest rates.
No, that's a great thing, and I wanted to point that out, Bob, just because of your background coming from banking, and I think that's a very important thing as we get into kind of our next couple of questions here, because we're going to talk about, why would a bank use some of these products? How can banks use this to their benefit? And so I just wanted to point out that you come from the banking world. You have that banking background. You're not a person that's unfamiliar necessarily with the customer that you're trying to serve. You come from that world. You understand that world, and I think that's a very critical part to this because again. I think a lot of bankers, a lot of times they're getting vendors or people are coming to them that aren't necessarily from that banking world, and sometimes they get a little frustrated because they don't know how to relate or really understand why the bank does some of the things they do or some of the decisions they make. So again, I just wanted to point that out. It's a small thing, but I think it's also a very big thing at the same time. So with that being said, could we talk a little bit about what you described as kind of like the level set, like what are swaps and why are they so widely used?
Sure. No, I think, at their essence, and I mean, the word derivative is, first of all, that's a charged word. I think somebody famously once called it the 11-letter, 4-letter word. And I did not do well in calculus. So but derivative just means something derived from something else. But the interest rate swap, I think, is the simplest and most vanilla instrument that would fit into that very broad category of derivative. And when we're talking about an interest rate swap, the power that comes with that is that you're really extracting the ability to transfer fixed for floating risk and handling it outside of the physical asset or physical liability. So the ability to put a contract in place with a counterparty, and it's typically going to be a Wall Street bank, a large, super regional or global bank are the primary, I would call them, manufacturers or the leading dealers in this marketplace. When a community bank would enter into a swap, say with a Goldman Sachs, the ability to quickly jump out of a pair of shoes that is a floating rate exposure. I'm exposed to, my margins shrink when rates rise, and I can take that floating rate and trade it in for a fixed rate without having to change my deposit mix, without having to turn a loan spigot on or off. The ability to steer the ship more nimbly and quickly is what really makes these instruments very powerful. But it's nothing more than a contract between two parties to swap interest rates, but you can't really swap a rate. So we have to turn that into a cash flow or a payment. And the way we do that is we have a face amount of the contract. We call that the notional amount. So it's essentially the principal amount on which we're going to calculate these interest payments. But the principal doesn't change hands. It's just a marker. And then the two parties settle up between fixed and floating over a set period of time. Easier to illustrate with a diagram, so we're getting a little wordy here, but it's a simple idea that has a lot of power.
Nice. And I think that's a great segue, because what I want to do is I want to bring in. So this is an article that I just wanted to show everyone while we were having this conversation here today, because I think this will help some people kind of contextualize what we're talking about here. So this is, again, one of my favorite websites. As anybody who's watching these other episodes will know, I love Bank Director, go in here all the time. So this was an article that was just put up on Bank Director, I believe, just a couple days ago. It's called "I hedged my balance sheet for the first time in 2023. Now what?" And this is written by Ben Lewis, who is a managing director and global head of sales. And I thought it was just a great article at pointing out here. It just talks about like strategic tool versus last resort, hedging versus trading, proactive versus reactive, consistent versus sporadic, and then holistic versus micro and macro. Now, Bob, without getting into the whole reading the whole article and everything else, what do you think? I mean, would this be a good if again, assuming nobody knows anything about this and they just want to just to kind of get a quick overview real quick, would this be kind of a good place for them to start, just to take a quick look at this article?
I think so. Ben's a very good friend and a colleague. That's a great article. The approach we take as a firm, and I think what the article really attempts to do is to create, I would say, the right mindset around these tools. And we often will say the idea that if you're a community bank, I would say if you're $500 million in assets and growing, you want to have access to these risk management tools in your toolkit. And then when that's there, think about it as a strategic discipline. It's not a once and done. I think because the economics of swaps have been so compelling, with the volatility, with the uncertainty, and with the way the pricing is set up, there's an inverted yield curve that provides some pretty interesting economics. There have been a lot of swaps sold, and we would say to a bank, do you want to be sold a product, or do you want to install a tool that you use in a disciplined fashion? So that's I think the point of the article is to really think about installing, gaining access to these tools, then reviewing possible use of the tool alongside traditional means to manage risk, like wholesale funding, changing duration in the bond portfolio. There's multiple levers you can pull to alter your rate risk profile, but the derivative is another one to consider, and just to do that at regular intervals as the ALCO meets, for example.
Nice, very nice. And for anybody who doesn't know, ALCO that's an acronym for asset and liability committee. Every bank has an ALCO committee, and I'll have to get into that and explain that in another episode. That's a whole nother conversation. But just for some context, so people understand what Bob is talking about there when he says ALCO. It's a committee that meets within the bank that tries to examine the bank's assets and liabilities, and to determine what the sensitivity is to different levels of interest rate fluctuation. Obviously, as Bob alluded to earlier, we've had a big shift in interest rates here in the last year and a half, and that's caused obviously I think Bob would agree with me on this. ALCO committees have probably been a little boring the last 10 years, until not so the last year and a half. The last year and a half, the ALCO committee was probably the hottest ticket in town. I mean, that every when banks were going in and having those meetings, there was a lot of hard conversations going on there about what to do and how to handle things, and what are some of the things at our disposal. And that's why I thought that this topic today, Bob, was so timely, because this really is a tool that I think can really benefit a lot of banks out there in the market. And I think that I don't know, and I don't know. I'd ask you, how many banks does your company deal with now? Just say across the U.S. Are we talking about dozens or hundreds? I mean, how many banks do you guys typically deal with?
No, we have about 250 bank and credit union clients. Really of down as $500 million, maybe some smaller, but that's usually the entry point at about 500 million. And then some banks that have grown up with us, we work with, well over 100 billion, some banks up that size as well. So doing different things for them in this space. So it's the service level looks different for the community bank versus the larger regional. But I think to your point, and thanks for throwing the jargon flag. When I do education sessions, even when doing the derivative elective at Stonier, I'll say if I throw out ridiculous jargon, just throw the penalty flag. Let's talk in plain English, and I appreciate you doing that a minute ago. But the ALCOs are no less boring this year. I think deposit rates have not yet, I think, peaked at a lot of places. So even with the Fed on hold and perhaps poised to cut, seems to be the consensus thinking right now. But there's still a lot of, I'd say, upward pressure on deposit pricing that's causing some margin issues.
Well, yeah, and we could get into a whole conversation on deposit rates and also what the Fed is going to do here over the next year. I think some of the inflation numbers that just came out, like in other words, my opinion is I'm actually not in favor of the Fed cutting rates right now. I think the Fed needs to kind of hold not necessarily increase, but I think they need to kind of hold things steady for a little bit and really make sure they've got the inflation thing truly kind of defeated and under wraps. Like I would not be opposed to the Fed maybe waiting another 6 to 8 months, just because interest rates they're a lagger. They take a while to kind of really get in to see what's going on. I mean, unless we really started to see signs that the economy was really going to start to tank, then maybe it becomes a little bit different conversation. But right this minute, and there's no doubt. I mean, the market right now, I mean, they're pricing in like I think a lot of rate hikes this year, not just like a few, which is a little baffling to me because everything we've heard from the Fed would indicate that while they may consider cutting rates, it's not going to be drastic rate cuts, or to maybe looking at 50 or 75 basis points. But yet the market seems to think it's going to be like 150 basis points, 200 basis points, and I don't know. I don't see that. I think that's a little. I think the market's being a little overboard right now at the moment. But that's just my 2 cents.
Yeah. Well, we plenty to talk about there. I think I'll just hold back for now. But I'll just say this though. I think I joked about this last week. I was at a conference down in Maryland. The Maryland bankers, they do a first Friday every January, and Tom Barkin from the FOMC, the Richmond Fed president, spoke. But the comment I made just to a fellow banker was that, I mean, the fact that nobody really knows what the Fed's going to do, that's why I have a job. I mean, the interest rate derivatives market, the ability to trade uncertainty for certainty, everybody's got an opinion. And even if you're running your bank with a view, the swap market actually is priced with 5 or 6 cuts in the next 12 to 15 months. And if you think they're not going to do that, you can actually get the benefit. If those cuts benefit you, you can grab them by doing a swap. So knowing what your own view is, but then bringing it to the swap market and seeing what the trade-off is, there's some pretty interesting opportunities. So I'll try to keep it high level there. But since you brought that up, I think, more to talk about there.
Yeah. Oh no, definitely. Without a doubt. So, so let me see here. I'm just running down my list of questions here real quick. So, do you, let me ask you this two questions here as we're getting closer to the end here. Is there anything right now, in other words, if you're working with a bank, is there anything that you might be advising them to be thinking about, like as we're getting into 2024 here, it's in terms of, them looking at their balance sheet? I mean, any just kind of general thoughts you might have of things they might be wanting to consider?
Sure. I mean, strategically, I think it really does depend on the bank's risk profile. So we don't ever come in with, here's the product everybody should do. Chatham's balance sheet strategies desk, in the fourth quarter and the beginning of this year, about half of our activity has been helping, I'll say, an asset sensitive bank, one that's exposed to falling rates, put on what we might call a down rate hedging strategy, more like a floor. Let's buy protection against falling rates because we're going to get hurt when the rates come down. But 50% have also been still doing what I would call up rates protection, so a pay fixed swap. And I think instinctively you might say, aren't we late in the game? Isn't it too late to hedge against rising rates? I mean, if we're at the peak, but with short-term rates in the mid fives and a 5-year swap rate not far from 3.5, there's that, well, I call it positive carry, or some incentive to actually pick up some relief from some of the pain you felt from rising funding costs, and protecting against a higher for longer outcome that's still possible. Like, yeah, inflation blipped up today. The Fed may just sit tight where they are, even though we all think they're coming down. They may not be in a hurry. So I would say that our recommendations really do depend on the bank's risk profile. I would go back to say, for banks of a certain size, if you don't yet have these capabilities installed in your native toolkit, I would say, take that step and get access to these tools so you can consider them on a regular basis.
Nice. No, perfect. That is fantastic. And just and I thought this was a good question just for the audience, for people that just don't understand or know much about derivatives. So I think, my mind always, you go back to 2008, you kind of hear that famous line from Warren Buffett of like, oh, derivatives are weapons of mass destruction. And the derivatives market has grown. It has grown exponentially since that time, since '08, over the last 15 or so odd years. Do you, as a person who works with derivatives every day and who's in that market, I mean, what's your general thought? Like, if somebody was to come up to you off the street and say, like, oh, I'm scared to death of derivatives, or I don't really understand them, or don't you have concern that this might come back and the derivative market might blow up on us somehow or something like that? I mean, just do you have any kind of general thoughts when maybe you're having a conversation like that with somebody?
Oh, I do, and I think first and foremost, you want to make sure you're putting in place the correct economic hedge. So you don't ever want to exacerbate your risk, and then regret the economic outcome of a swap because the market didn't go your way. You don't want to even bet if you're hedging. If the hedge goes bad, then your natural position should go well. I mean, so there shouldn't be any, remorse on the economic outcome. But I think if you're going back to '08 and thinking about what I'll just call, I remember it was talked about from the moment I started this, I'll say this deep dive back in the '80s, this idea of it's a house of cards, right? If everybody's trading with everybody, if one falls, will they all fall? We were close to that moment in '08 with AIG and then the Wall Street banks. The important thing to keep in mind, and it's sometimes I bring it up at board meetings a lot when I'm doing board education sessions, is that since the crisis, the regulators mandated derivatives, we would call them over the counter, just a bilateral two-party contract, to be moved to a clearinghouse for the largest banks. So $10 billion and up, if you're doing interest rate swaps, a central counterparty or a clearinghouse would stand in between you and the party you traded with, and that's a cash collateralized, cleared position. Even for the bilateral, again, the very simple vanilla swaps that we do for community banks today with the likes of Goldman Sachs, US Bank, other counterparties, they actually will agree to a two-way cash collateralized agreement. So you think about all the different, swap going back and forth between all these different people. At the end of the day, our clients are entering into a cash secured obligation with Goldman Sachs, as an example. So that's really made counterparty risk, I would say, the number one risk when you go down the laundry list of what are the risks of interest rate swaps. Counterparty risk was always my number one. And post crisis, and now 16 years later now, the ability to secure that risk with cash makes this a much safer game to be playing. The banks that did swaps with Lehman Brothers in '06 and '07, we saw folks take losses on those. They were not secured. Lehman went under. There were losses. But today you do end up with a secured position, and that helps a lot.
Yeah, and I just wanted to point that out because, again, I think there are a lot of misconceptions out there in the market, and I think there are a lot of people that don't necessarily know a lot about derivatives, and they just think about those kind of stigmas that are out there. So I just think it's good that a lot of people understand that the market has changed. Going back to the very beginning when you talked about kind of how when the company first started in the mid '90s was a little bit of like the Wild West, and that a lot of companies were using derivatives in a much more riskier fashion than, like you said, a lot of the plain vanilla stuff that kind of goes on today. And the way that the whole system is designed today is very different from what it was 15, 16 years ago. So I appreciate that, Bob. I mean, definitely thanks for pointing all that out. So at this point, I'd like to get in as we wrap up here. I like to my two kind of favorite questions I like to ask of all my guests is, do you have a favorite business book, and do you have a favorite business related movie? Maybe something you've seen in the last couple of years, or something that you like.
Sure. No, I gave that some thought. I, I think if I go in the book direction, I'm just going to pick Michael Lewis's books are great. So The Big Short, I preferred the book to the movie. That might be my favorite, but Flash Boys was fantastic. And my first read was
Yes.
Liar's Poker. When I went from being a commercial lender to sitting in the trading room with the bond traders of my uh, bank, I remember even being invited to play in the Liar's Poker game. So Liar's Poker, when he was at Solomon Brothers, that's a great read by Michael Lewis. And then the movie, it's going to be a complete shift of gears. I have to go with It's a Wonderful Life. I am the son of a community banker. My grandfather was also a community banker. So George Bailey Building and Loan, and just the relationship aspect of banking that is on display there, and just even the banking lessons about liquidity and the bank run scene. It's a lot more than business, obviously, but that's a lifelong favorite of mine for sure.
Oh no, it's an absolute classic, and I definitely I right there with you. I highly recommend anybody who has not yet seen A Wonderful Life. It's not just a movie about banking, but it's a movie about life, and it's about just great lessons learned in life in general. And so that's why I think that movie has really stood the test of time. But you got to love the fact that it's the local community banker. That's the main guy in the story, Jimmy Stewart, the hero of the story, and it's just fantastic. And I love your point about Michael Lewis. I just used I actually have been doing like this crypto series, and I just used Michael Lewis, his new book called Going Infinite, which was all about SBF and FTX. Amazingly, Michael Lewis was actually there with SBF when the whole company was going down, because he was planning on writing a book about him. But obviously, the book that he was planning was not about the failure. It was going to be just talking about the success in the crypto market and everything. And then he just happened to be there when the whole thing imploded, and he got a firsthand account of everything, which is kind of wild. I mean, how often in life would something like that ever happen to somebody? But we used his book. But yes, and I review a lot of books here, a lot of business related books on the podcast, and definitely Flash Boys is one of the ones I've got that I'm going to be doing here in the next couple of months. So I'm really looking forward to that. And obviously, Liar's Poker is a classic. The Big Short is a classic. And I agree with you. I actually did The Big Short. I liked the book a lot more than I did the movie. The movie was great, but I enjoyed the book more than I did the movie. So
Yeah, I'm
which
glad. Yeah, I know you are. I knowing you, Joe, I know you're a very well-read individual. So I've been waiting for that book to come out on crypto. So I didn't know it was out yet. So you just, I think, gave me a weekend read to consider.
check out the episode I did. It was the crypto series. It was part 4 of the crypto series, which was basically. Oh no, I'm sorry. It was actually part 3. It was because it was really focused on kind of the crypto crash of 2002, and just all how that all transpired and what happened there. And like I said, I thought it was a great read. I thought it was fascinating. My only drawback on it was that I thought that Michael went a little easy on Sam Bankman-Fried. That was really my only criticism of it. But other than that, it was a great book, and it was very fascinating. So it just I find the whole crypto thing to just be a very interesting, an interesting world with a lot of interesting characters. That's for sure.
I will check that out.
But anyway, but thank you so much for joining us today, Bob. I mean, I really appreciate you coming on. And just so people know, our plan here was that today's podcast episode was going to be kind of a general conversation, kind of the macro level. I am going to invite Bob to come back so that we can do an episode on the micro level, because I would love to show just, one or two examples of how some of these kind of vanilla derivative contracts work that Bob was explaining earlier in the episode. And so we're going to have Bob back to do that. And so I think at that point, people will really get a real idea and a general understanding of how these things work, which again, I can't wait to do. But thank you so much again, Bob. I really appreciate you coming on and spending the time with us today.
My pleasure, Joe. Thanks for having me.
Thanks. All right, everyone. Well, if you like this today, please make sure to like, subscribe, leave a comment below. I always love everyone's comments and try to get back to everybody as best I can. Please make sure to check us out. We're on YouTube. We're on, what are we on? We're on YouTube, Rumble, and all major podcast platforms. So I just thank everyone for joining today and hope to see you again real soon.